Hi, welcome back to accounting. Man, I go white every time. It's like when I lean back, the focus gets weird. But all right, aesthetics are not our goal here. So welcome back to accounting. I think this is lesson 5. I'm not too sure on that, but I believe this is lesson 5. Today we're going to be talking about provisions, reserves, and allowances. So provisions, reserves, and allowances. Another key principle of accrual basis accounting. So remember, we are in accrual basis accounting. Never forget that we are in accrual basis. Key idea, not cash basis. So the first sort of paradigm for this principle that I want to talk about is actually related to accounts receivable, which we've talked about a little bit. I actually warned you. I remember warning you early on that this concept of accounts receivables, they're gonna come up again, and today is that day. So obviously, when it comes to recognizing revenue and going through the billing process, the billing cycle of collecting revenue and recognizing it, you have your revenue on the income statement, and then you have your accounts receivable, and then you have your cash, right? And basically, it's this idea that when a customer gives you money for a product or service, whenever that is earned, it is recorded in the revenue and in the accounts receivable. But of course, we are recognizing, or we are writing down these accounts when they're earned instead of when the cash is received, which is why we have the accounts receivable, because oftentimes you don't receive cash right away. So we have this line, this account called accounts receivable, for pretty much money that customers owe us. And then eventually, whenever the customers do end up paying, that is converted into cash. Then we finally have the cash, right? And that's the cycle. But I know a lot of you out there, when we talked about this concept of accounts receivables, or accounts receivable, I know a lot of you out there, I know I was one of them. When I first learned about this concept, my first thought was, well, you're kind of writing down accounts receivable. You're kind of writing that down under the assumption that people will convert it into cash, and that everyone's a good creditee, if you will. And it kind of seems like accountants are oblivious to this, but in fact they aren't, because I'm going to introduce you to this principle called allowance for doubtful accounts. And essentially, allowance for doubtful accounts is a percentage of liabilities that the company expects to just go completely bad, for the creditee to completely default, and you as the creditor will be eventually it'll be an expense to you. You actually won't receive the cash. So when it comes to, and it's important that this allowance, for me to tell you that this allowance for doubtful accounts, it is known as a contra asset. And a contra asset is sort of similar to the idea of a liability, but it's still on the asset section, and it's sort of like a subsection under an asset account. So what it would look like on an actual balance sheet is that you would have your accounts receivable, and say that's 500 million, right? And under the accounts receivable, you would have an allowance, and say that's 100 million, so 1/5. And you would subtract these, and then your net accounts receivable would be 400 on the balance sheet on the asset section. So that's what a contra asset is, and that's what our allowance for doubtful accounts is. It's a contra asset. And when it comes to actually calculating the allowance, It is essentially just a percentage of accounts receivable, a percentage of the liabilities. And this percentage varies per company because the way that they derive this is different per company. Essentially, they do some sort of empirical analysis, some sort of statistical analysis. They look at prior trends and they say, well, maybe 5% of our customers end up defaulting, and it's they don't actually give us the cash. So that's how they determine essentially how that's done. So if you have 100 million in accounts receivable and there's a 5% allowance, you would take that out for the net accounts receivable of 95. So that's how that is calculated. And at the end of every period, you eventually, it looks like I'm getting an email from Express. Great clothing store, by the way. Anyway, I don't actually fall for these retail scams, by the way. I don't actually pay for things I don't actually need because I get some random coupon in my email. Good marketing tactic, though. So anyway, thanks Express for that interruption. Where was I going with this? Man, that completely threw me off. We were talking about, so at the end of every period, you have those accrued doubtful accounts. Those allowances are built up, and you'll eventually know whether or not your customers have defaulted, and eventually you would expense that on your income statement as well as your balance sheet. You would get rid of the allowances on the balance sheet. You would make it whole, essentially, and replenish that, and then you would expense the bad debts. That's what they're called. So you would replenish that and then expense the bad debts on the income statement. So that's just sort of the idea that not everyone pays their bills. So we need to account for that on the balance sheet. And it's important that whenever you're looking at a company's financial statements, that you understand that the billing process and how accounts receivables are actually accounted for, and the idea of doubtful accounts. So the second thing I wanted to talk about was accrued bonuses. And this is just another extension of the idea of the accrual basis accounting. So obviously, for employment, some kind of services or employment, you earn bonuses, and this is basically the idea that bonuses earned in one period, when they're paid in another period. So say you earn a bonus in this period, but it's actually paid out in this period. Well, pretty much what we do is, since it's earned in this period, we estimate what will actually be paid out, and then we account for it here. So that's how we would handle bonuses, and that's called accrued bonuses. It's the basic idea. And you also have something like accrued retirement, or the liability for retirement benefits also follows an idea similar to this under our accrual basis accounting. So basically, retirement benefits, whether it be a corporate pension or whatever, they accrue over time. So typically, if you have an employee and say they work 35 years, they work 35 years, and the company sets aside some money in a pension or whatever, they invest it, whatever it may be, for 35 years. At the end of the employee's term, they pay this out for the employee to retire. They pay it out in one big lump sum, and they live happily ever after. Well, you would think, accountants, maybe they expense that one big lump sum in one period, but no, we are under accrual basis accounting. That's not how we do it. So what you do is you take the accrued retirement benefits account, right, on the balance sheet, and this is basically, every period, we take 1/35 of the total retirement benefit, and we tack it on to the accrued retirement benefits account. So we expense this every year over the long period, instead of all in that one lump sum when we actually give out the payment and it's going out of our pocket. Yeah, we call it the accrued retirement benefits. So 1/35th of the total retirement benefit is expensed, and we save it up in that account. Yeah, so that's essentially the basic idea. Obviously I'm trimming a lot of fat here. We're just doing the fundamentals on these YouTube videos, but that's sort of the idea for provisions and reserves and allowances. It's the idea that we're estimating future expenses and future accounts. We're estimating them and actually accounting for them, or putting an allowance for them, or whatever it may be. And we're doing it whenever in the period in which that loss occurred, or in the period in which that revenue was actually earned. So this video was really just an extension on the idea of accrual basis accounting. Man, I really am very white in these videos. Man, that's annoying. But yeah, this is just an extension in this accrual basis concept. Just wanted to come on here and explain a few things. Hopefully these videos have been helpful. Thank you.